Have you ever dreamed of creating an income stream that works for you, even while you sleep? An engine of wealth that pays you just for owning it? It might sound like a far-fetched fantasy, but it's the reality of dividend investing. And today, I'm going to show you step by step how to build your very own Monster Dividend Portfolio starting from scratch. Forget the confusing jargon and the intimidating charts. This is your ultimate beginner's guide to turning small, consistent investments into a powerful source of passive income for your future. Whether you're saving for retirement, a down payment on a house, or simply want to achieve financial freedom, you've come to the right place. Let's get started. Before we build our monster, we need to understand its DNA. So what exactly is a dividend? In the simplest terms, a dividend is a portion of a company's profits that it distributes to its shareholders. Think of it like this. When you buy a stock, you're not just buying a ticker symbol on a screen, you're buying a tiny piece of a real business. When that business does well and makes a profit, it has a choice. It can reinvest all that money back into the company to grow, or it can share some of that profit with its owners, the shareholders. That share of the profit is the dividend. It's a direct reward for your ownership. Companies that pay dividends are often mature, stable, and have a long history of consistent earnings. They're the established giants of the market, like utility companies, consumer goods brands, or major banks. They might not have the explosive growth of a brand new tech startup, but they offer something else: reliability and a steady stream of income paid directly to you, usually every quarter. This is the foundation of our portfolio, owning pieces of solid businesses that pay us to be a part of their success. Now let's talk about the monster mindset. The word monster might make you think of fast, aggressive, high-risk moves, but in dividend investing it means the exact opposite. A monster portfolio is one that grows into an unstoppable force over time through patience and consistency. It's not about getting rich quick, it's about building sustainable wealth for the long haul. The first step in this mindset is setting clear goals. Why are you building this portfolio? Is it to generate an extra $500 a month in 10 years? Is it to fully fund your retirement in 30 years? Your goal will determine your strategy. To help you on this journey, there are a few key metrics you need to understand. First is the dividend yield. This is the most common number you'll see. It's the annual dividend per share divided by the stock's current price. For example, if a stock is $100 and pays $4 per year in dividends, its yield is 4%. It's a useful snapshot, but be careful. Chasing the highest yield can be a trap. An unusually high yield can be a red flag that the company is in trouble and the stock price has fallen, or that the dividend itself is unsustainable. Next, look at the payout ratio. This tells you what percentage of a company's earnings is being paid out as dividends. A healthy payout ratio is typically between 40% and 60%. If it's too high, like 90% or 100%, it means the company has very little money left to reinvest in its own growth or to weather a tough year, putting the dividend at risk. Finally, and perhaps most importantly for building a monster portfolio, is the dividend growth rate. A company that consistently increases its dividend year after year is a powerful sign of financial health and management's confidence in the future. A 3% yield from a company that grows its dividend by 10% each year is far more powerful in the long run than a stagnant 5% yield. This growth is what will supercharge your returns over time. Alright, with the right mindset in place, it's time for the action plan. I'm going to walk you through a clear 3-step build to construct your portfolio from the ground up. Step 1 is research and discovery. This is where you become a detective, hunting for great companies. But where do you even start? A great place for beginners is to look at lists like the Dividend Aristocrats or Dividend Kings. The aristocrats are S&P 500 companies that have increased their dividends for at least 25 consecutive years. The Kings have done it for 50+ years. These lists aren't a guarantee of future success, but they are a fantastic starting point for finding high-quality, reliable companies. Use free online stock screeners. You can filter for companies based on dividend yield, payout ratio, and years of dividend growth. But don't stop there. Once you have a list of potential candidates, dig deeper. Look at the company's balance sheet. Is its debt manageable? Are its earnings growing? What industry is it in? And what are the long-term trends for that industry? You want to own businesses you understand and believe in for the long term. This brings us to step 2. Diversification is your shield. You've probably heard the saying, don't put all your eggs in one basket. In investing, this is the golden rule. No matter how much you love a single company, putting all your money into it is incredibly risky. If that one company faces unexpected trouble, your entire portfolio suffers. Diversification is your defense against this. It means spreading your investments across various companies in different sectors of the economy. Think about it. If you only own tech stocks and the tech sector has a bad year, your portfolio will take a big hit. But if you also own stocks in healthcare, consumer staples, companies that sell things people need regardless of the economy, like toothpaste and food, and utilities, a downturn in one sector can be balanced out by stability in another. A good starting goal for a beginner is to aim for 10 to 15 different stocks spread across at least 5 or 6 different sectors. This ensures that no single company or industry can sink your ship. It creates a resilient portfolio that can weather market storms and continue to generate income. Now for the most exciting part, the secret ingredient that turns a good portfolio into a monster portfolio. Step 3. Unleash the power of reinvestment. When you receive a dividend, you have 2 choices. You can take it as cash, or you can reinvest it to buy more shares of the same stock. Most brokerage accounts allow you to do this automatically through something called a dividend reinvestment plan, or DRIP. Choosing to reinvest is the single most powerful thing you can do to accelerate your wealth. This is the magic of compounding. Let's run some scenario math. Imagine you invest $10,000 into a portfolio with an average dividend yield of 4%. In the first year, you'll receive $400 in dividends. If you take that as cash, your investment is still worth $10,000. But if you reinvest it, your portfolio is now worth $10,400. The next year you'll earn 4% on $10,400, which is $416. You reinvest that and your principal grows to $10,816. It doesn't sound like much at first, but over time the effect is explosive. After 30 years, assuming no change in stock price and a consistent 4% yield, that initial $10,000 investment where you took the cash would have paid you $12,000 in dividends, and your principal would still be $10,000. But the reinvested portfolio? It would have grown to over $32,400. Your dividends aren't just earning dividends, they're creating a snowball of wealth that gets bigger and faster as it rolls downhill. This is how you build a true monster portfolio, by letting your money work for you, and then letting the earnings from that work also start working for you. It's a virtuous cycle that, with time and consistency, can lead to incredible financial results. So, let's put it all together. You've done your research, you understand the need for diversification, and you're ready to harness the power of compounding. It's time to make your first buys and, just as importantly, track your progress. Tracking is essential. It keeps you organized, motivated, and focused on your long-term goals. Seeing your projected annual dividend income grow with every new investment is one of the most rewarding parts of this process. To help you do this, I've created a comprehensive dividend tracking spreadsheet, and I want to give it to you for free. This is the exact tool I use to monitor my portfolio. You can input your stocks, the number of shares you own, and your cost basis, and it will automatically calculate your total portfolio value, your overall yield, and most importantly, your projected annual, quarterly, and monthly dividend income. It helps you visualize your progress and see your passive income machine being built in real time. You can find the link to download your free tracker in the description below. It's an invaluable tool that will make your dividend investing journey so much easier and more rewarding. So, to recap, start with a solid foundation of understanding what dividends are. Adopt the long-term monster mindset. Follow the 3-step build. Research quality companies, diversify across sectors, and always reinvest your dividends to unlock the power of compounding. Building a monster dividend portfolio is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. But by starting today, even with a small amount, you are planting a seed that can grow into a mighty tree of financial freedom. Thank you for watching. If you found this guide helpful, please give it a thumbs up. Subscribe for more content to help you on your financial journey. And don't forget to download your free dividend tracker. Now get out there and start building.